Good morning, guys. Hope all is well. It's January 31st. Today is Wednesday. It's about 8:30 Pacific time. Markets starting with the Nasdaq. Nasdaq down about 235 points as I speak, mostly driven by the big mega cap stocks. Apple, Amazon seem to be down in sympathy with earnings from Google and Microsoft. Although Microsoft was terrific earnings, just taking a break from 52-week highs, which is not a bad thing. And Google actually had good earnings, but the stock is still down about 5% to the 140 range. Decent entry if you want to be able to go for the long haul, but I think it might go a little bit lower to 135 range, and that might be a good opportunity. Usually, it doesn't give you too many good opportunities near the 200-day moving average. It gives you an opportunity in the 100-day moving average, and it's close to that right now. Take a look at Google, might be a good entry for it right now. IMD, I think, also had poor forecast guidance, but I would wait for a little bit more on AMD stock. All right, let's get to one of the stocks on the radar, Arista Networks. Now, to give you a little bit of context, back in 1994, 96, I used to work at Cisco Systems, so I know the networking space fairly well. The intent of this specific uh, video is not to go deep into all of the speeds and feeds and the gear of networking, but at least give you a basic good overview about why Arista Networks is special in this space versus a Cisco versus a Juniper, which got acquired or which is going to get acquired by HP. Okay, so that's the context on Arista Networks. They are essentially a switching and networking provider. And one of the key themes and the reason why they're doing so well is because of cloud, specifically AI. Okay, so they are in a very fast-growing opportunity market, which is cloud networking gear for AI-related workloads. Now, Arista provides networking for a lot of companies. They have four major segments. Segment number one is enterprises. These are Citibank, Wells Fargo, JP Morgan. They build out their data centers. They need networking gear, whether it's on campus, which is their offices, or for the data center. That's first. Second one is service providers. So these could be companies like CenturyLink, which provides my internet connection, or it could be someone like Verizon or AT&T that provides internet capabilities as well. So they buy switches from Arista. The cloud providers are the biggest buyers of core and versus adjacent networking gear from Arista Networks. That's the third segment. And the fourth segment is just everybody else for campus networking. So keep that in mind. They're in a very fast growing opportunity right now because of cloud. Usually, I would have said that the growth rate was in the 15% range. Now it's gone to 30%, 20 to 30% range in the last 1 year, a couple of quarters. They've done a very good job of just growing revenue very, very well. Lots of people buying networking gear for AI workloads, especially Microsoft, AWS, Google, etc. The key things that differentiate themselves. So networking overall, we'll go through this a little bit. The key thing is to be able to make sure that you understand that networking gear is needed across the board for a lot of different things, all the way from your computer connected to a hub or a local DSL if you're working from home, or to a local Wi-Fi network related switch, then connected to your data center, then connected to the router, then connected to the internet. So you need a scalable system. Now, you need different gears as well. So you have the 7 layers of the OSI stack. For people that don't know, networking itself requires you to have 7 different layers, from the application layer to the presentation layer, to the sessions layer, to the transport layer, to the network layer, and then to the physical layer itself, right? So you have 7 different layers, and you need gear or software across the board for all of these different systems. What EOS, which is Extensible Operating System from Arista, comparable to iOS from Cisco does, is gives you that operating system that can run across all of these switches, so there's consistency of integration. And they're also a lot less expensive in the long term to hold than Cisco gear. Cisco makes everything. They make routers, they make switches, they make hubs, they make gateways, they make everything and software. Whereas networking, specifically switching, is where Arista Networks is really good at. So they make core switches and they make adjacent switches, and they're trying to move and diversify away from just the cloud networking market across to campus networking market as well. Most of these companies will have differentiation driven by both either silicon that they make on their own, which Arista doesn't do. They use merchant silicon. What merchant silicon means is they actually use third-party chips, such as Intel chips or any of the others, including Qualcomm chips, versus what Cisco does is a mixed use case. Some of the silicon they develop themselves, some of the silicon they buy from merchants. Okay, so if you look at the basic networking requirement, you have your computer that connects to a bridge, sometimes maybe to a hub. That is connected then to a hub, which is the next layer, consolidates a lot of different computers. Then it connects to a switch, then it connects to a router, then it connects to a gateway and goes across. And of course, a lot of these computers are very different. So a lot of these networking gear requirements are very different. So some people connect via network via a mobile phone that might need a much different networking requirement than maybe a PC, than maybe a server. So that's what differentiates a lot of these things. On the data center, however, you have a three-tier architecture that is required. The servers themselves need to connect to each other within a rack, and the racks need to connect to each other across the access layer. The access layer of the racks connecting to each other then needs to connect across all of the systems within that data center and then switch across to the core layer going to the outside, which is connecting to the rest of the internet. So this three-tier data center network architecture requires switches, routers, bridges, gateways, hubs across the board. And that's what the networking requirements associated with the data center. So Arista Networks has been around for roughly about 14, 15 years, 2009. The company has been around since then, went public in 2014, has done very, very well since it's gone public. They're doing roughly about $5.6, $5.7 billion in trailing 12 months revenue, or last 12 months revenue, as they say it here, growing at about 20%. Gross margins in the 65% range, 60% is what they're looking for, and operating margins in the 35% range. So 42% was the last 12 months, but they're growing at about operating margins about 35% on an average. They have lots of customers, thousands of customers. Most of them are in the campus networking area, but a lot of them use it for data centers as well. Okay, so when you look at how the evolution of networking has happened, specifically for Arista Networks, over time, it has gone from what they call leaf spine, which is the ability to create very small pizza box looking networking switches that occur within the rack within the data center itself, to then going to universal cloud network. What happens is you aggregate a lot of these. No longer do you need one data center, 5 data centers. The hyperclouds have 150, 250 different data centers. To then getting to the point where a lot of this is very cloud managed. So SAN, what they call software defined, SDN, software defined networking. You try and move as much away as possible to virtualizing your network, so you don't have to depend on a specific switch if a switch goes down, but actually virtualize them and make it a lot more easy for a cloud platform. Cloud platforms want to do this. So Microsoft, whether it's Google or AWS, they want to go to more of a software-defined network, cloud platform-based, data-driven network, as opposed to very switch-based and hardware-based. Hardware-based is very prone to error, prone to falling down, prone to breaking, prone to problems, whereas software defined makes it a lot more easier to be able to manage it across multiple ones. So what has Arista done over the years? The 5 A's, as they call them, evolving at cloud speed. The 5 A's is, first, they try and start with the ability to be agile, which is move very quickly. They have leaf spines that are very, very repeatable. So they build design patterns as opposed to making it so that every network is connected to every other switch, connected to every other network. They actually make it a little bit more hierarchical. They automate as much as possible, making sure that you can roll out the network in a very quick way, give you quick analytics that makes it easy for you to be able to understand which portion of the network needs to be balanced very well. They give you API-driven, software-driven, again, back to the software-driven networking area. They give you API-driven capability, so you can manage not only provision, you can manage, and you can also roll out your network more efficiently. And now what they're doing is to be able to go more to the real-time AI-driven networking. So the workloads that are required for AI are dramatically different from a read-write perspective into the rack that you have than they were before. Previously, it used to be a read-only. Now it's a read-write requirement, so it becomes a lot harder. The management team itself. So these are two people that I worked with before, so I'm a little biased. Jayashree Ulal and I worked when I was in Cisco in the 94 to 98, 96, 97 range. And Adi Bertelstein is a legend in the industry. He is one of the founders of Sun Microsystems. So he's had a phenomenal exit even there. He has been one of the early investors in Google as well. Maybe, if I'm not mistaken, he maybe wrote the first check for Google or something like that. A phenomenal legend in the industry, Andy Bertelstein. He's one of the co-founders of Arista Networks. Jayashree is the CEO of the company. She's also a billionaire just because of Arista Networks. And a lot of the other folks in the team are very qualified people, I'm sure. I don't know as much about them, but both of these folks I've worked with before. Super smart people. Okay, Arista is now going from a $30 billion 2023 TAM more to a $51 billion range, moving across to more of a cognitive network, AI-driven capability for networking overall. What is their core is continuing to grow a little bit, which is campus networking switches, but the cognitive adjacencies and cognitive network, which is how do you go about trying to help build AI-based networking capability, is where they're seeing a lot more work. Software services, those are where they're continuing to see a lot more capability. Okay, so in the switching market, campus Ethernet switches, think of campus Ethernet switches as offices. And then the data center is the other part, campus versus data center. Switching required specifically for building out large-scale data centers or small data centers, and then what you would use when you and I go to office or work from home or whatever the case might be. Most of the money comes from large businesses, building out large campuses and having networking to be able to connect everybody to everybody. Medium businesses about 30%, and then small businesses about 10%. Large businesses make about 50% of the overall market for campus switches. Then you have the data center switches, the top five: Google, Alibaba. Actually, start with the biggest one: AWS, Azure, Google, Alibaba, the top five service providers. And of course, there's a bunch of others, but IBM is a number fifth. Oracle could be counted as a number five. If you take out Alibaba, then you could put Oracle and IBM in there. So those five, top five US service cloud service providers, AWS, Azure, Google, IBM, and Oracle, make up nearly about 40% of the market. The Chinese cloud service providers, as you know, Baba, Tencent, and Baidu make up another big portion. Then you have the rest of the cloud providers, which is Dokkan, people like DigitalOcean, DLR, and Equinix, and so on and so forth. A lot of those guys. Then you have the telco service providers, such as Verizon, such as AT&T, so on. And then large enterprises in the data centers. Large enterprises still have their own data centers. So that's a big part of the market as well. They see large enterprises will actually start to grow a little bit more over the next few years, because now that they've gotten a good handle on what works on the cloud, what doesn't work on the cloud, they're going to go use more of a hybrid approach. Some of it is on the cloud, some of it is on their own on-premises system. So it gets to about $50 billion, $51 billion. Okay. All right, now we look at Arista's market leadership. They actually do a very, very good job of being able to do, so there are different speeds that are required of all of these switches. Speeds from 1 gigabits per second all the way up to 1.6 gigabits per second. And the need for those switches, the 1 gigabit seems to be dropping more than anything else. The biggest need is in the 800 gigabits per second. That's the growing market more than anything else. Speeds are getting bigger, speeds are getting much, much higher. The reason is because these networks are more dense than before. The requirements for the needs for compute, not only on the NVIDIA side, but also the networking side, are also much, much higher. So in the 100, 200, and 400 gigabytes, they've been the absolute dominant in terms of port analysis, which is the number. So each of these switches has multiple ports. You will connect each port to one specific output port of a server system, and that connects it to the rest of the gears. Okay, where they've really done a good job is, look at this. This is 42% of the market. Phenomenal ownership by market share ownership by Arista. Cisco is actually doing okay, but losing market share. RM is the rest of the market. So Arista has done a very good job of growing this market in the 100, 200, and 400 gigabyte switches market. Very, very strong analysis there. And if you look at market share gains versus Cisco, so just to give you context, Cisco is about a $205 billion company in terms of market cap, $56 billion, nearly 10 times the size in terms of revenue of Arista Networks, but only 4 times, not even 4 times, it's actually 3.5 times the size in terms of market cap. So that's because they've been losing share to Arista Networks. Cisco's been losing share to Arista Networks in the high-speed data center switching market, which is the fastest growing part of the networking market. Okay, so a lot of the reasons why Cisco actually announced that they're going to do not so well in 2024, 2 quarters in a row, they're going to struggle a little bit, is also because Arista has been doing a very good job of taking share away from them. But again, remember, Cisco's footprint is large. So when a company is doing $56 billion, growing at 20% is very hard. For a company doing about $5 billion, growing at 20% is easier. But Cisco in both the dollars and then also in share reports has been losing market share consistently to Arista Networks. Okay, so core networking, switching in software and services, and then adjacency. What they call adjacencies, what other products can you sell besides the core market? Cloud and AI seem to be the biggest trends where they're growing the fastest. Enterprise and financial services sector, as I mentioned, Citibank, JP Morgan, they're about 35% of the market. Service providers and tier two cloud providers, about 20% of the market. So the big portion of money is still coming from AWS. As actually, if you remember here, they talked about the top five cloud providers being Amazon, Apple, Google, Facebook, Microsoft. So those are the ones that are, according to them, the larger cloud providers. I do think it's IBM and Oracle, but these are the guys that are buying a lot of the data center equipment from Arista Networks. 80% of the market for Arista is in Americas, as you can see. Okay, the vision for 2025 is to continue to grow their core business from an AI perspective, enhance their operating system stack, if you will, and then go more into routing and campus away from data center alone, which is where they've been successful, and move more into WAN routing, edge servicing, etc. And then define and get into more of the security layer of the network, which is zero trust networks. This is going to be something that is competitive to a Cloudflare, to a ZS, not exactly and directly, but they're moving more of the security requirements into the network as opposed to keeping it on the application layer. You'll need security in both layers, but they're going to win quite a bit over there. A lot of the analysts have very positive view on Juniper Networks. I'm sorry, Arista Networks, Juniper Networks as well, as you can see from this. Where you see Cisco here is here. Look at that. Compared to Arista Networks, which is the absolute leader by far. Huawei is doing well as well, but they tend to have a very specific market, mostly outside of the US. Within the US, Arista is just absolutely killing it. Okay, just a summary, why do people choose Arista Networks gear over others? They are modern, they are scalable and programmable. So I talked about being software-defined networks. They give you a lot of data and information, which is telemetry about how your system is doing, how your network is performing, how can you scale it as required. They have a lower total cost of ownership than any of the other competitors. And their claim, this I don't know for sure, the claim is the EOS, Extensible Operating System, is a lot easier and simpler to use. And of course, every company that has gone to this level of stage will do very well with support. Okay, so their vision is to be able to have a consistent from the public cloud as one of their key segments of the market, cognitive campus, data center, WAN bridge, and internet core. Across all of these segments of customers, they run on top of EOS, which is the extensible operating system, data-driven management and networking that is defined by software, and then operational model that allows you to be able to scale it effectively. They have a whole suite of products. So they have the 7 series products, which are cloud and data center products. Then they have the EOS-driven spine products, leaf products, and then finally towards the right-hand side, the core routing and workload, intensive workload. And then at the bottom, you'll see so on the left-hand side, you'll see a lot more of the ones that are sold in excess numbers. And on the right-hand side, these are sold fewer, which means they tend to be a lot more expensive. And then at the top is spline-based, and then one is leaf-based. So leaf versus spline is you actually get a complete networking, if you will, much longer, bigger box. And at the bottom is just individual units themselves. So they can use them across. So the smaller ones, the campus, the branch, the leaf at the bottom are used mostly by smaller networking companies and maybe campus and enterprise. The larger ones at the top are used mostly by the service providers. So whether it is the big 5 cloud providers or also service providers. What is merchant silicon? One of the questions I get asked, I don't know if anybody's asking for it, but I'll tell you anyway. Merchant silicon is using third-party semiconductor as opposed to building their own. So Arista focuses on working with people such as Intel and others to be able to say, we're not going to build the silicon ourselves. We're going to focus on the software layer, and we're going to focus on the design layer. And that's their EOS, the extensible operating system, and not so much worry about the silicon. So they optimize it based on the silicon that comes from third-party providers. Their EOS is built on top of a Linux kernel, so it's also open source. It built on top of open source. The EOS is not open source, so it's built on top of open source. Open subscribe, publish subscribe model makes it very easy to be able to move. And they actually use a lot of different, as you can see here, Intel primarily tends to be a lot of their silicon, but they tend to use a lot of different examples, a lot of different other silicon providers as well. Okay, so we talked about these are spline. Let me go back. These are spline, 760 series, 750 series are spline, leaf, sorry, and these are spline at the top. So they have a lot of different capabilities to be able to build a lot of different kinds of gear depending on the workload that you might need. Okay. AI in particular requires a lot of chips with very high bandwidth to be able to do very quick transactions back and forth. And also you need higher density. So density and throughput tend to be the two most important elements of that. So they not only do switching, they're also getting into the routing, the core routing itself. Now, this is going to take a little bit more time for them to be able to define very well. So this is this is what we want to do. Going from the data center all across to the peering edge network, they're going to take a little bit more time to do. The company itself has executed very well. This is Q3 of last year, 2023. So the next results come out in a couple of weeks too. I think it's February 12th. So revenue is about 1.5 billion, growing at 28%, so close to 30% growth. Gross margins 60%, net margins actually the 30%, operating margin 46%, EPS of $1.35. Consistent revenue growth. See that even quarter over quarter, they've been growing revenue consistently. Growth margins have been consistent in the 60% range. Operating margins in the 40% range. This has done a little bit better, so they've optimized a little bit, and EPS has been consistently growing it well. From the 1.5 billion they got in net income, they bought almost about, they retained about $900 million. They purchased, along with debt that they took in, they purchased about $670 million in shares. So they're doing a lot of buyback. And they did a few acquisitions, strategic opportunities that they can see to grow their business on an ongoing basis. So that's Arista Networks, just as an overview, what they do, what they don't do, etc. What we're going to focus on now is going to be our 5-step process for looking at Arista stock, seeing what we like about it, what we don't like about it. I can tell you right away, I think what I don't like, what I will not like about it is their valuation is pretty darn rich, but we will get to that in good time. Okay, so let's look at the financials, fundamentals as we start first. I already gave you a little bit of a feel for what the financials and fundamentals would be, but let's look at it. We always start from a high level perspective. So 1.3 billion in 2016. 8 years later, that is nearly 4 times. So it's gone from 30% growth, 40% growth, 30, slowed down during 2020 timeframe, and then jumped back right up again to 40%, 50% almost growth in 2022. Trailing 12 months is about 30%, I think. Gross profit, we talked about it before, 60% range. Net profit in the 35% range. That's very good. Okay, so let's look at it from a quarterly perspective. Yeah, it's going up to the 30%. So slowing down again from 50s down to 30s, down to late 20s, so early 30s kind of a frame. So this is also because of comps. Look at this, 50% growth in these years. So the comparables are going to be hard to come by. Net margins are growing in the 50% range. So that's good. So very efficient as well. Not only are they growing top line, which is good, they're also becoming more efficient. They're growing their bottom line by 50%, almost twice that of their revenue growth, meaning they're being efficient in their usage and in their operations. Okay, balance sheet, their total assets of about $8-9 billion. $7 billion of that is literally in current assets and cash, little to no debt, very pristine balance sheet. Cash flow from operations, they're making about 600 million, nothing to complain about. Okay, let's look at their valuation. Price to earnings of 45. Okay, so this is rich, but it's growing at 30%. Keep that in mind. For a company doing about $5.something billion, $5.6 billion in revenue, and growing at 25 to 30%, it's a little bit rich. To give you a context, Cisco is growing, literally not growing very well. Cisco is growing about 7% year over year, but their valuation is in the 15 range. Juniper Networks growing at negative 4% or something like that is what they announced a couple of days ago, yesterday, when Juniper announced earnings before their last earnings before they might get acquired by HP, and their valuation is in the 12 PE range. So Juniper is a very rich stock. I'm sorry. Arista Networks is a rich stock. I'm going to go back to ANET. I already know the numbers at the back of my hand for Cisco, so I'm not going to necessarily spend a lot of time waiting for this to come back up again. Arista Networks is a pretty rich stock. 45 times and 6 times is rich. This is a very, very rich stock. So keep that in mind. Let's just go through that portion of it again, just to confirm. And look at the margins as well. Margins, we said 65% gross margin. So 15 times price to sales is very high. Earnings are growing fast, so I'm not worried about the price to earnings. It's going to come down. Earnings are growing at 50%, if you remember, and sales are growing at 30%. So this is high, but this is beautiful compared to, look at this. Earnings multiples have just risen through the roof. The PE multiples haven't risen. Okay, PE multiples have gone up 50%. Earnings multiples have gone up 50%, almost 100%. Sales multiples have gone up 100% almost, whereas PE multiples have gone up only about 50%. Gross margin, the 60% range, net margin is a 35% range. That's pretty good. On a scale of 1 to 10, I'll give this an 8. This is a phenomenal balance sheet, phenomenal income statement, very good fundamentals. Okay, so Arista Networks, let's go to the monthly chart first. They're going up and to the right. Yeah. So this is one of those beautiful stocks to follow. Very little. So look at this. Built the base, did a series 2 markup. Very nice distribution, markdown, again up, and a very nice base that was built, markup. Did a series stage 3, markdown, and then since then, this is another markup, and then stage 1 again, and then this is beautiful. This is a dream stock. I don't know why you would ever sell a stock like this. Just buy it and keep it. This is a phenomenal company. Don't even worry about this. So on the long-term basis, this is a stage 2 markup phase. Okay, let's go to the weekly chart now. Okay, on the weekly chart, you can see that they have a little bit of a resistance over here in the 100 and 274 range, 264, 260 is where it is right now. So this is going to move a little bit down. This thing always does this. I'm going to show you this very interesting thing that I noticed because I've held the stock for a long time. And I keep telling you, don't sell the stock. This is not a stock worth selling. So the interesting part about the stock is what happens just before earnings. Let's look at the last 4 earnings, and you'll see a pattern here emerge. Just before earnings, stock goes down, and then booms, goes up again. So look at this. This was the previous earnings. Look at the day before the earnings. So I'm going to draw one little box here. Day before earnings goes up, goes down, sorry, and then starts to move in the right direction after that. Let's look at the previous earnings. Moves down before earnings. Look at that. Day after earnings, recovers nicely up and to the right. Let's do another one. Moves down before earnings, up after earnings. This is what's going to happen. This is going to move a little bit down, probably get back. So where does it move? The previous earnings, it almost got down to the 100-day moving average, 100-day or below the 100-day moving average, close to the 200-day moving average, close to the 200-day moving average. So this should, it's not going to come down that much. February 12th is the earnings, is it? Yeah, February 12th is the earnings. So this could come down quite a bit. Right now, it's the 50-day moving average is 255. It should technically, if it behaves like the way it has, it should come there between the 230. Yeah, it should easily come to the 230, 240, 250 zone is where I think it is going to come. And then we'll move back up again. That'll be a good entry. Somewhere in the 240 zone would be a very good entry for the stock. Just look at how consistently it has behaved. Before earnings goes down, look at this. Actually, this one was a little bit different. Before earnings is moved up and then continued to move up. Let's summarize ANET for you. Strong growth, 30%, nearly 25 to 30% growth in revenue, 50% growth in earnings, very strong AI tailwinds from growth in the cloud providers. The top 5 cloud-centric US companies, Facebook, Apple, Google, Meta, Microsoft, AWS, big customers of theirs, the big 3 in the China as well. Campus networking is going beyond where they are right now. Very strong differentiated value proposition. They're moving away from AI alone to campus-based networks as well. Strong company. If you look at the moving averages, they're up and to the right, but moving a little bit down in the 5 days. So they're still positive, but I think they're going to come between the 240 and the 250 range. The RSI just taken a beating today. And I think it's probably going to head somewhere in this range, the 49 range. And this MACD curling down as well means it's going to come down a little bit. 250 to 240 would be a very good area for you to be able to buy it in. And if you want to be able to hold it through earnings, wait for the drop till it comes out for earnings, then move on from there. Thank you very much for watching. Let me know what you think in your comments.